Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we're diving into a Form 8K filing from the Federal Home Loan Bank of Pittsburgh, or FHLBank. Now, before you click away thinking this is going to be dry, let me tell you, even a bank that sounds like it's straight out of Monopoly can have some interesting stories to tell, especially when it involves trillions of dollars. This report, filed on March 11, 2025, isn't your typical earnings announcement. It's more about how the FHLBank is managing its debt, specifically through something called consolidated obligations. Think of these as IOUs, but on a massive scale, used to fund loans for member banks. The big question is, how safe are these IOUs and what does it mean for the housing market and economy? Let's find out. Let's start with the core of the report, the creation of what they call direct financial obligations. Basically, this is about how the FHLBank borrows money. They get most of their funds by selling debt securities, also known as consolidated obligations. These are like bonds and discount notes. Here's the important part: these consolidated obligations are not just the FHLBank of Pittsburgh's responsibility. They are, by regulation, the joint and several obligations of all 11 federal home loan banks. This means that if one bank can't pay, the others have to chip in. It's like a financial safety net within the system. Now, who's watching over all this? That would be the Federal Housing Finance Agency, or Finance Agency. They can make any federal home loan bank pay up if another one is struggling to cover its debts on these consolidated obligations. This adds another layer of security. The report mentions that these obligations are sold to the public through the Office of Finance using authorized securities dealers. This is how they get the money flowing. It also clearly states that these obligations are backed by the financial resources of all 11 federal home loan banks, not by the United States government. It's crucial to understand that there is no government guarantee here. Schedule A, which is part of this report, is where things get a bit more specific. It lists all the consolidated obligation bonds and discount notes that the federal home loan banks are committed to issue. The FHLBank of Pittsburgh is the main borrower or primary obligor for these on the trade dates listed. There is an important exception to this information. They are excluding discount notes that mature in 1 year or less and issued during normal business. It also includes consolidated obligations that have a remaining maturity of more than a year. We're talking about big money moves here, not just short-term borrowing. The report does give a few heads up. First, even though this debt is a big deal for the FHLBank, they're not saying every single bond or note is material or important enough to change the big picture. Also, Schedule A doesn't include interest rate exchange agreements or other financial instruments that they might use to manage their assets and debts. This means there could be other factors affecting their financial situation that aren't immediately obvious. The report also makes it clear that Schedule A doesn't give you a complete picture of the total debt outstanding. It doesn't include those short-term discount notes, and it doesn't show how the money from these new bonds will be used, like paying off old debts. To get that full picture, you'll have to wait for their regular reports filed with the Securities and Exchange Commission. Finally, the dollar amounts in Schedule A are just the face value of the bonds. They don't include any discounts, premiums, or concessions, so the actual cost to the FHLBank could be different. Here's where we can find Schedule A, the list of consolidated obligations. Unfortunately, the actual amounts and dates are not specified in the current report, as the report only refers to the existence of the schedule rather than disclosing its full contents. So what's the takeaway from all of this? Well, the Federal Home Loan Bank of Pittsburgh, like the other federal home loan banks, is a major player in the housing market. They borrow money by selling bonds and notes, and then they lend that money to member banks. This helps those banks provide mortgages and other loans to people and businesses in their communities. The key strength of the FHLBank system is the joint responsibility of all 11 banks for these consolidated obligations. This creates a safety net, but it also means that if one bank is in trouble, the others could be affected. One potential weakness is the lack of a government guarantee on these obligations. While the banks themselves are supposed to be strong enough to back them up, any major financial crisis could put that to the test. Also, the report itself admits that it doesn't give a complete picture of the FHLBank's financial situation. There are other factors, like interest rate agreements, that could affect their ability to repay their debts. Overall, the FHLBank of Pittsburgh seems to be operating in a fairly stable manner. However, it's important to remember that the housing market and the financial system are complex and interconnected. Any major shocks could have ripple effects throughout the system. So while things look good right now, it's always wise to keep a close eye on the situation. For investors and those working in the financial sector, this 8K provides essential transparency into the FHLBank's debt management practices. The structure of joint obligations and the oversight by the FHFA offer some reassurance, but the absence of a federal guarantee emphasizes the importance of ongoing monitoring of the FHLBank's financial health. Thanks for tuning into Corporate Decoder. If you found this breakdown helpful, give us a like, drop a comment, and subscribe for more insights into the world of corporate filings. Until next time, stay informed.